Hi, I'm Mike Cintolo, Chief Analyst of Cabot Growth Investor and Cabot Top 10 Trader, and I'm here with your Cabot Weekly Review, and I have some pretty good news this week, I think. Now, the last video or two, we had talked a little bit, and I'd been writing in the issues. We're starting to see some improvement in the broad market. There was a positive divergence in the NASDAQ late December on the retest of that index. Early January, we saw new lows dry up on the New York Stock Exchange. A little too early to tell because you got the cross currents in early January, holiday trading in late December, all that. The good news is that this week, the broad market has really been persistent and powerful, so much so that our own 2-second indicator, which is the number of new lows on the New York Stock Exchange, that indicator has turned positive, or at least given an all clear. Yes, it's descriptive and not necessarily predictive, but for the first time really in a year and a half, 2 years, we're seeing very, very low new low readings on the New York persistently day after day. Pretty good sign. Possibly even better is that the 2-to-1 blastoff indicator that we follow flashed green on Thursday. It's really only flashed, I think it's 13 times since 1960. It's pretty much always portended very good gains when looking out 6 to 12 months. And usually there's very little drawdown from the signal, meaning it's not like you correct 15% first and then get going. Now, we did see some what I call mini blast-off signals last year, things that they don't quite have the track record as this one and one of the other ones that we follow closely. And those things failed miserably. So as with everything, it's one piece of the pie, it's one piece of evidence, but it's certainly a good piece of evidence. And I think really from a top-down perspective, it's not 1999 out there, but I think we're starting to see some of the clouds part and some rays of light. Now, individual stocks are still tricky, especially on the growth side of the equation. A lot of conferences this week releasing guidance. Some things did crack, unfortunately, but still seeing a lot of setups out there in medical, biotech, Chinese stocks. We'll go over a lot of these names. Stuff like that, commodities, cyclical names. There's more and more stuff that's acting well, showing some volume clues. And it might not be ready to just kite higher, day after day from here. They are setting up well. And what I have my eyes on is earnings season here. If we start to see some gaps in the next week or two or three, especially among some of these growth names that have put in the work over the last year or two to set up a big structure, I think it could be go time for the market, okay? Let's hop into the charts. Again, this week, I'm going to start with stockcharts.com. It's a great free site. Use it all day long. Check it out. There's a subscription portion to it, but they have free and subscription if you want to use it. And this is the same chart we looked at last week, which is just the number of new lows on the New York Stock Exchange. Again, we use the 40. It's a log scale, so it looks a little bit more extreme, but we use the 40 level here, which is this blue line, this kind of demarcation. There's nothing magical about that, like 41 is bad and 40 is perfect. But it's just a level that historically, when the market is healthy and the market's going up and the broad market's healthy, those number of new lows usually are pretty tame. And especially coming off a bear market low, usually what you see is just kind of what we've seen now is some sort of breadth thrust, some sort of thing going from modestly oversold, not too good, to really overbought in a short period of time. And historically, that actually is very bullish for the market. I know it doesn't sound like it would be, but it is. And you can just see on this chart here, now this goes through yesterday. I'm recording this late Friday morning as usual. So this goes through Thursday. But we saw so far this week, Monday, Tuesday, and Wednesday were all single-digit readings. And then on Thursday, the readings were 12, okay? And so far this morning, I don't know, it was 3 or 4. I mean, it's early in the day. So we'll see what happens. But overall, we're just seeing this. And really, there hasn't been, I went back and looked. This is an eyeball test, so don't totally quote me on it. But I went back and looked, and the last time you had, 3 or 4 readings of 10 or less or 12 or less or whatever, it was back in like February, January, February 2021, kind of near the, growth stock peak after a big run, the last time things were kind of humming. So I view that as a pretty good sign. In terms of the 2-to-1 blast off indicator, I'm going to write more about it and stuff. I can't, show it all here, but suffice it to say that this is the New York Stock Exchange advanced decline line. And just take my word for it that when you kind of look at this recent thrust from very late December through yesterday, again, this is through Thursday's data, on average, more than twice as many stocks went up versus going down every day for 10 days. Again, it's very rare. I think in total it's happened like 20 or 22 times since World War II, basically. If you take out some of the repeat signals, meaning, there was 3 of them in 2009 sort of thing when the market was taking off, if you take out some of those, then, you're down to 12 or 13. On average, a year later, the average maximum gain in the S&P is like 25%, and the average maximum loss is like 2%. We'll see. Like I said, last year, there was a couple of these, like the S&P had 90% of stocks above their 50-day lines. Historically, that was pretty bullish, but It's just the S&P 500. It's not the whole broad market. And as we saw, that thing, that signal failed and the market went on to new lows, or to at least retest its low in the fall. So anyway, it's not the be all end all. There's no one perfect, indicator, but to me, it's very encouraging. And just in general, from top down, it's just kind of a trust but verify situation. You need to see now the indexes and leading stocks begin to get going. If they do, I think we could kind of get heavily invested in the weeks ahead. Obviously, if they don't and the Fed comes out and the market fails, guess what? We'll take a couple paper cuts, but we'll retreat. We're still heavily in cash, but we'll retreat further and just stay safe until the tide truly turns. Okay. Now let's see. Let's hop into MarketSmith. Let me switch over my right here. Okay. So now we're using MarketSmith, product of Investors Business Daily. You can learn more at marketsmith.com. We'll start with the major indexes. Get my notes up here. Just with here's the NASDAQ, is still kind of bringing up the rear. And this rally, granted, in the context of, all this stuff that's been going on, it's not the be all end all. Okay. But I will say even the NASDAQ is above its intermediate and short-term moving averages, the 50-day and the 25-day line right here. Okay. We'll see how it goes. Still below the 200-day line. The other indexes, though, it's kind of like I said last week. I was like, hey, if we had a good week or two, all of a sudden you're looking at things above all their moving averages and hitting multi-month highs, So we're not quite there yet. Well, in some things we are, but it's one of these situations. So here's the S&P, nice rally, obviously, the last few days in the market, testing its 200-day line. Now, to be clear, it kind of tested it here, pulped above it, failed, obviously, tested it here, tested it here, tested it here. The 200-day line has been very tough to break through. So I would just say if the market can hang in here, you want to see it go up, but if the market can push higher or even hang in here and push higher next week, that would obviously be a good sign. In terms of the intermediate term trend, again, I'm still calling the overall intermediate term trend more neutral than anything, just because we're still kind of in this area, of the past 2 or 3 couple months, I guess I would call it. But there's no question that the latest rally is encouraging. Okay. Here's the Russell 2000. Now, this is kind of what I'm talking about. All of a sudden now, here you have the IWM above the 200-day line, above the 50-day, above the 25, above all its moving averages and really ramping. And of course, the small and mid-cap indexes, this is MDY, are going to feel that effect of the breadth. That's when you have strong breadth. This is kind of what you're looking at more than a market cap heavy index. Again, above all its moving averages. You do have this overhead resistance, so I'm not trying to say it's 1999. The bear market's definitively over, call the margin broker. I'm not trying to say that here, but there's no question that if you're focused on the market and not the news, that there are definitely some rays of light, some legitimate rays of light, not just hope, but real rays of light, okay? Interestingly, I think I said this last week, the New York Composite is actually the strongest index and actually, I think, nosed out to really multi-month highs here this week. So we'll see how it goes. The intermediate term trend could, I think, click positive if we build on these gains pretty quickly. Longer term would take a little bit longer. But so far, obviously I like what I see. The other thing, obviously, I like to point out this most weeks. So here's XLP. This is consumer staples. Really, here was the low for the market in October. And the initial phase here into early December was led by the XLP. And for that matter, it was led by like the Dow Industrials. Here's the Dow right here. But it was led by defensive stocks. It was like, all right, let's put some money to work, but safely. Now we're starting to see, it's not, crashing or anything like that, but you clearly have seen this level off here and not rally while the indexes that showed you all were doing this over the last 5 or 6 days. It's not, we have an indicator that our aggression index, it's not positive yet. It's the NASDAQ versus the XLP. It's not there yet, but it has shown improvement. And again, it's one of these things where it's a good start. Now you just want to kind of see it build from here, okay? Just one other index, because I have a lot of stocks to go through. XBI, so I've been watching this, and I apologize for saying the same thing a lot, but this is the monthly chart. This is sort of a broader biotech index, not just IBB is a little heavy in some of the really mega cap names, which can be a little defensive. XBI is a little bit broader. You can see from its top, it was really one of the leading groups here in the 2013 to 2015 move, that sort of thing. But it hasn't done anything net since 2015. So that's a pretty long time. Yeah, that's 7.5 years, okay? And now we're just seeing, obviously it showed some strength. It bottomed back in the summer. It did pull back here, but you can kind of see it looks nice and tight on this chart. This is an ETF. It's going to be different than just an individual stock. And then this week it's really popping nicely. Again, there's some overhead here. Who knows, maybe it fails or something like that, but it is encouraging action. And I still think that, I'm open to whatever as always, but if the market got going, capital I, capital F, I still think that biotechs and medical and stuff like that is in certainly as good position as any growth areas to really lead higher, along with some retail too, some growth retail. But I think biotech and retail look a lot more likely to lead than obviously like software and networking and stuff like that. Okay. So just on that theme, now this is a little bit more defensive. This is Gilead Sciences, no real growth. It's cheap. But I would just say, and you can just see even just volatility wise, this is the weekly chart. It hasn't really done that much, net. But this was a huge breakout on earnings a couple months ago, and it did have a huge run. We had it in top 10, and actually we did take profits, luckily, up here. But it's had a nice shakeout. It's handled itself well, and you are seeing a lot of these stocks kind of hang around and test their 50-day lines. Kind of an interesting risk-reward point, how you want to handle it. It's up to you, whether it's buying it here, not buying at all, waiting for maybe a resumption of the uptrend is one popular thing. Something like that. But Gilead is a bigger, sort of safer name in the group. Sarepta Therapeutics, SRPT. Now here's a good example. The stock broke out here, had a run, a big shakeout here, hits new highs, comes all the way back down. So I mean, it tests people. Obviously the market isn't great. It hasn't made any progress for really a few months. But after it tests the 50-day line, look at today, boom, it's up, whatever, $8. As I record this, we'll see how it closes, but pretty good action there. Inspire, I've mentioned a lot, INSP. I like the story. The stock's a little thinner, not liquidity-wise. It's a high-priced stock, but it only trades 300,000 shares a day. But I just think this is it depends how you want to measure it. But to me, the stock basically hasn't done anything for 2 years. And then now you have this persistent advance, and now it's granted it's only 3 weeks, but it's pretty nice and tight in here on low volume as it tests the 50-day, the 50-day line, the 10-week line sort of thing in here. They have earnings here February 7th, so everything's coming up with earnings, of course, but nice setup. How you want to handle it up to you, but obviously a nice breakout would be encouraging. And then Penumbra, PEN, this was in top 10 recently, again on the medical device side. Very sloppy and choppy history sort of thing. Topped out for a while, then it finally got hit. But it has changed character a little bit. You can just see just here, yes, there's been a little selling, but you can see a lot of the blue. You didn't see a lot of blue here, okay, down in this period of time. You see a lot more blue skyscrapers on the weekly chart here, and just tighter since this shakeout. Nice little tight area here, starting to resume its uptrend. Yes, there's overhead, but my point is there's a lot of biotech and medical names that look pretty good. Commodity stocks are interesting. Some names not so good, but some names continue to look good, even though oil, I know it's up this week, but I think oil is still $80 or 70. It's not like it's roaring ahead back to 100. But here's Schlumberger, big shakeout here, but held up pretty well, and just looks like overall, you kind of have this big bowl and it comes straight up. Ends up being a nice consolidation, and the stock has busted out to new highs here. It does have earnings next week, I guess, January 20th. And I wouldn't say volume's amazing, but again, it looks pretty good. On the thinner side of things, now this is sort of a turnaround. This is Diamond Offshore, which is like an offshore driller. A lot of these things just really, during the dry times, they either went bankrupt or bought out and reorganized. But it came public again. It is a thinner stock, just FYI, okay, low price, thin, all that sort of thing. It's only $1 billion market cap. But obviously discounting pretty good things here. And after, kind of ramping up here to new weekly closing highs, tightened up for a few weeks. And on the daily chart, you can see, a nice thrust to new highs here on pretty good volume, so far in the new year. Okay, we'll see how that goes. And then some, there's a decent amount of like cyclical and construction and all these names. This is Southern Copper. Now, copper prices have gone up, but, it's pretty powerful. I'm not saying you want to go chase it. Maybe you do. I mean, if you chased it 3 or 4 days ago, you'd feel pretty smart. But, you have this big, obviously kind of top in here, big correction. The weak hands are out. It's not like it's been going up 1,000% the last couple of years. And again, it just seems to have changed character, nice and tight on the bottom, couple of big weeks, nice and tight for a couple months, and now letting loose on the upside, obviously with a lot of volume. That looks pretty good, and peers in the copper space look pretty good. China, I mention this every week. I'm kind of thinking China, it's a little obvious. It wouldn't surprise me, especially because we're still seeing selling on strength of some of these Chinese names. Maybe go a little bit higher and then shake out a little bit just as things have been going. But we are seeing stocks not just go up, but you're seeing some of the volume clues here. This is Alibaba, not the be all end all, but again, same pattern as all these stocks. Huge wash and rinse back in March, shakeout to new lows in October, I think it was, and then really a change in character since. A lot of the names look good. This is HTHT. This is H World Group. It's basically a cookie cutter hotel story. It's been around for years. Obviously, hotel's not the place to be when they're not letting you out of your house in China. But now that things are different, I find it interesting that there was actually a higher low here as opposed to the vast majority of Chinese stocks had that shakeout. And it's changed character. And again, you're getting some pretty good volume this week. You can just see really since the turn of the year, the buyers are here. A little bit of a it moves around a bunch, you can see, but we'll see what happens. Wouldn't surprise me, like I said, near-term pullback, but my guess is unless it's some disintegration, some massive decline, any sort of weakness or shakeout would probably lead to higher prices. And then you have just a smattering of, I mentioned, retail, here's Five Below, released some pretty good Q4 numbers for one of the retail conferences in early January. Just again, you kind of had this nice accelerating thing here, and then this was obviously an earnings pop. And then, yes, it pulled back, but, just held the 25-day line. And now, again, you're starting to see some pretty good volume as the calendar is flipped. You're going to see, again, this, it's year end. So, yes, you're going to get some tightness because it's usually less volatility. But, some nice tight areas in here, nice tight closes starting to resume its uptrend. That looks pretty good. Uber is a name. I mentioned it in CGI this week. Now, I thought it was ready to just blast off back here. This was after during the vaccine rally, kind of, a reopening play. And it did okay, but then it eventually fell apart and just keep falling apart and all that. Now they're very profitable on an EBITDA basis, getting more so every day. And again, this one bottomed back here in, I think that was June or July. I think it was July. Huge earnings in August. And then it has pulled back, but you can see it's remained well above that low, and now it's starting to resume on the upside. It needs work. It's got some resistance to chew through like all these things, but above the 200-day line. Let's see if it can hold it. You can see it's tried to, it's gotten above there a few times and not held it. So let's see if it can hold it here. And just we'll see what happens. I mean, you don't want to read too much into day-to-day, but just look how, up and down this action is here. You see this all over the market right now. It can change, but so far, you just get wild days. Just the ranges, up, down, up a few days, down a few days. And now just look how tight and quiet every day. I mean, I don't have like the range on here, but I bet you it's half as big as it was a couple months ago. It just seems to be these things are coming under control a little bit. We'll see if it can continue. Okay. Now, one is wild. This is ARRY. Now, solar stocks, they've been up, down, and all around. Okay. This is interesting because of the power. Now you can see it moves from 24 to 14. So this is still, very, very volatile, but I am just looking at it as it held the 200-day line a couple of times here. The 200-day line's trending up. Pretty big shakeout last week, and then a nice higher volume week. You can see huge up week this week. The thing can move around so quickly. It's hard to, even if it did break out, it's hard to really have a ton of confidence. You'd love to see this thing settle down like some of these other names, tighten up a little bit, or maybe break out and then pull back nice and calmly, that sort of thing, to offer a lower risk entry point. But huge sales and earnings, nice chart. The sector is still mostly intact. There's a few areas there. Airlines, I'm not an airline guy, but I am a price and volume guy. And when you run your screens, you're kind of like, hey, there's a lot of airline stocks that bottomed many, many months ago, usually after the war started in Ukraine. Hacked around here, but, obviously a change in character, huge. You can just see just straight up here since the year began. It's even more telling on the daily chart like we were seeing. I mean, 37 to 51 or whatever straight up. Today, I think one of the Delta or somebody had disappointing earnings, but the group is still kind of hanging in there. And I mean, obviously it's barely down. We'll see how it goes. I mean, oil prices can change, but it certainly seems like, these huge earnings estimates that people have, they're starting to discount like, hey, why is this thing so cheap, so to speak? Chip equipment stocks. I had mentioned this a few weeks ago. They look good. They did pull back here. They tightened up. They got hit after the Federal Reserve in December. But most of them held pretty firm in here, a little bit below the 50-day line. And this is ASML, which I think looks the best of the bunch. Again, you kind of had this shakeout here and then a change in character. You can see the sell-off here really wasn't pleasant, but it wasn't on huge volume. And now the stock is kind of asserting itself on the upside, not on huge volume. So we'll see. I'm sure this has earnings on January 25th. But ASML, KLAC, there's some of these that look pretty good on the chip equipment space. And just a couple more of random names. This is MCore. This is sort of in this construction, non-residential construction sort of thing. Again, not the most dynamic name, of course, but I mentioned this in the past. Oop, I think my mouse just died. But let's do it on the computer here. You can see that the stock really ramped up here. I think it was 9 weeks up in a row. You can see the big volume, 4 weeks of volume cluster here. It did pull back, but you can barely see it on the pullback. Okay, on the chart, I mean. So very, after doing this, it did this. And that looks very calm, cool, and collected if you're just looking at that red line. Now it's starting to kind of reassert itself. I would assume they have earnings here in 2 or 3 weeks type thing, but that could be a resumption pattern. And then just to say this, this isn't my thing at all, but I did just I have some screens that are very broad, just like, hey, what's going up basically. Just notice some REITs. Now, these aren't out of the woods, but this is ADC, looks pretty good. Equinix, bottomed way back here. Again, you kind of had this thrust. Reasonable pull, sharp, but reasonable pullback, and now resuming to new highs. So you're just seeing some action in some of the, the REITs, some of the interest rate sensitive stuff and all that. So back to the market, not to put too much weight on, hey, new lows are low or the 2-to-1 blast off, therefore everything's fine. Last year never happened. No. I'm not saying that. We're still below. A lot of stocks, number one, are still seeing selling on strength, and a lot of indexes are either at or still below their 200-day line. So, I'm not trying to get too far in front of my skis, but I do think that we've started to see a few breadcrumbs, sort of a trail here with the broad market, which is kind of classically what you see near lows. You've seen terrible sentiment. Now you've seen a legitimate, breadth thrust. And let's just see. Let's see if some of these stocks can finally follow through on the upside. Let's see if, the S&P 500 here can, not just toy with its 200-day line, but actually get up and through it, sort of thing, okay? So it's going to be a step-by-step process. There's not going to be one day next week or 3 weeks from now where you say, oh, wow, it's a bull market. It's going to be a step-by-step process if it happens. So just take it day to day, week to week. I think it's worth putting a couple lines in the water, putting a little cash to work, and then just being vigilant and seeing how things go from here. Okay, that's all the time I have for today. Thanks for listening. Be sure to come by again next week for another Cabot Weekly Review.